Daniel, Gen Wealth Concepts here. How do I become my own banker? That is the question I'm going to explain or answer here in this video. So there's a few things to consider. One is it's really a concept. One. Two, you are using a participating whole life, properly structured policy in order to accomplish this. Some people will say you can use indexed universal life, and you possibly can, but the actual concept was started and for the most part revolved around whole life, the guarantees of whole life. So you're guaranteed to grow more than the year before. So I pay in $10,000 a year. This year, I have $11,000 for this year's cash value paid in dividends. Next year, it might be 12. The following year, it might be 13, 14. It's always going to go up. Whether it's usually a multiple, whether it's $1,000, $3,000, it usually goes up by a certain amount every single year. And that is the idea. So one, you have to start out with that. That's what I do. I help people figure out what they're comfortable paying. In some cases, or a lot of cases, you should be slightly out of your comfort zone. It pushes your savings up. Rate of savings it will always beat rate of return. Because if you have $10 and have a high rate of return on $10, okay, fine. But if you have a lower rate of return, but you're saving $10 a day, there's a big difference, right? So if you have savings and you're saving money, rather than sitting in a bank account collecting, less than 1%, even if it's high yield, it's 1%, maybe 1.5, if you can even find that. There are some boutique banks, and when you say boutique, maybe boutique's the wrong word, but some of these fintech banks will promise a higher rate of return or a return on your savings account. Downsides: one, it's taxable in the year that you make it. Two, obviously the tax reduces your gain. And three, if you actually go to access the money, you're reducing your principal. You're reducing the amount that you have compounding the interest. So yeah, if you put it in there, let it sit, it can compound interest, but there's still taxes to take into account. And so on the flip side, if you move that over to something like whole life, cash value whole life insurance, you are getting a higher rate of return. It has an internal rate of return, so it's a little different, but the internal rate of return might be 3.5% to 4%, depending on the insurance company, after expenses. So not only is it 2, 3, 4 times, whatever it is, depending on what kind of interest rate you're getting on your savings account, more, it's tax-free growth. You can still access the money, so you still have full liquidity. And that same amount of money, so let's just say you had $10,000, that same $10,000 is usable, well, depending on what year it is and how it's structured, and there's a lot of little things. But let's just say if there's $10,000 in cash value and you borrow against the policy. Well, the policy, that $10,000 is still going to be credited for that year off of the full amount. Even though it says there's no cash value available, there's still going to be a dividend credited. and it's going to be based on a 10,000, and then the following year and the following year and the following year, and that's going to keep growing, and it's going to keep growing no matter what. There's nothing to worry about in this scenario with sequence of returns. And if you, okay, say for example, in your investments and stuff, you see sequence of returns of, okay, you had $100,000, it dropped 20%. And then if you look at it, it's like, okay, it dropped 20%. So now I'm at $80,000. And then they tell you, or you look at your account and it went up $20,000. Well, most people just think, oh, it went up 20% and I lost 20%. So I'm even. Well, you're not, because 20% of $80,000 is $16,000. So you're $4,000 down from, and that cycle of different things just keeps happening. So when they give you averages, I don't feel like averages are accurate, because if you actually had started with $100,000 and then, however many years later, and you actually put it into a calculator where it grew at whatever percentage rate it is for those amount of years, the number's not going to add up because of the ups and downs in the average. You come back to the sequence of returns. Now, you're not going to have that with a life insurance policy because, as I explained, you put in your premium every year that you pay that premium, you're going to have more money than the year before. So it's different. Anyway, I'm getting off the subject, becoming your own banker. So one thing you have to consider is, if you're saving money and you really want to maximize, the general guideline is 10 times your age per month. So if you're 40, that's $400 a month, and $4,800 a year. That is, they say that's kind of a jump off point. I mean, I probably started off smaller, because whenever I started doing this, I was dead broke. I was starting a business way back when, and somebody told me I needed to do this, so I scrounged together whatever little extra money I could, or maybe I really didn't have it, and made sure I was making payments, and it's paid off a lot. I mean, I have several policies now, but it paid off so much that I keep doing it over and over. But whenever you do this, you're either doing it for a number of things. So another thing that, people talk about is getting out of debt. Becoming your own banker, money can still grow while you use that money to pay off debt. And then those payments that you would have been paying into those credit cards and those different things that you're consolidating your debt with, now those payments are going back to the policy. And, at a certain point, if you had, let's just say you had $3,000, $4,000, $5,000 worth of bills every month because you have a family and you've got a lot of bills, you got kids, you got a significant other, all that money now becomes savings, because every time you pay back that loan, you are, you're building that up. And so, $3,000 a month, for example, is $36,000 a year. Who doesn't want that? Instead of going to the bank and to the banks, you're putting that money back. And even without that money being per se back, because you're borrowing against the policy. So it is putting it back, but it's not in a way, because the money that you had borrowed or initially paid in as premium, and year over year you paying in as premium, is still growing. Like because it's really truthfully never left the policy. So it continues to grow while you use your money. So you're making your $1 work twice. So, say you get out of debt, now you have all this extra money. And, because a lot of times whenever we do these plans, people are getting out of debt, with 30-year mortgages and cars and credit cards and whatever, they're getting out of debt. And under 10 years. Sometimes it's more, it just depends on how big the policy is or how much they're putting away and how many policies they have. But we put all this info together and we put it into the software, and with the software, it'll give you a timeline, runs all the calculations and everything, shows you what should be going back into the policy and when, and whenever it was paid off, now that payment goes back to the policy. So it's, once you're done with that, or maybe before, it just depends on your, risk tolerance, your thought process, all kinds of different things. Depends on the individual and their, like, who they are. I won't even say who they are. I'll just say that their thought process is going to be, it could be they just want to get out of debt. They don't care about anything else. They don't know anything about any other investments or business opportunities, and that's just them. Great. They're still way better off. And they continue to do this. And, now you have your assets and whatever, and they're all paid for. Your cars, your house, whatever. And all that money is now being poured into your policy. So if it's a $2,000 a month mortgage and credit cards and whatever, and maybe that's another, couple $1,000 a month, it's $5,000, it's $60,000 a year going back to paying yourself back. So, and then once you've paid yourself back, if you still have all that cash value sitting there, you run out of places to put it, you start another policy, or at some point you start another policy on your significant other, and you start one on your kids and whatever, and it becomes your kids' savings and part of their part of your legacy that you in your estate planning, and it pays for their college, and it can do a number of things. But the idea is to leverage the life insurance policy into a living benefit, into actually utilizing the money while you're alive instead of just being a death benefit. You'll still provide a death benefit. These policies the death benefit's always above and beyond whatever the cash value is. Even if you use up all the cash value, there's still going to be, if there's outstanding loans and something happens to you on your policies, for example, your kids will still have a death benefit. Your significant other will still have the death benefit of usually still a fairly substantial amount of money. And as this evolves, you have more and more policies, and there's more and more death benefit. Ideally, there's more and more cash value while you're living, and you're able to use it to truly do things to enjoy yourself. I mean, things that you wouldn't maybe be able to do otherwise, that you've always wanted to travel to a certain destination, or maybe you want to buy something. Maybe there's a dream car you have, or I'm throwing out random ideas, but it's all about building your wealth, and it's not necessarily a get rich, quick scheme or anything. But if you stick to the plan, it works. I can tell you, I'm 14 years in personally, and it works. I did it on blind faith personally, and somebody told me you need to do it. It was a mentor of mine at the time. I connected with the agent that he was working with, and I've never looked back. It truly gives me joy to log in to the insurance companies and look at, what the growth is and what it's going to be, and getting my yearly in-force illustration. It really makes a difference. It allows us to do things such as go on vacation. We've been in tight spots before because my business wasn't maybe doing great at one point, because there's always ups and downs in businesses. For those of you who are business owners, you know that there's ups and downs. And for me, there was times that things were amazing and beyond amazing in my business, and there was other times where it had a slow period of 3 to 6 months. But I had all this money on the side because of my policies and the growth and the amount of years that I've had them, and whatever, and just you're socking away this money. And I can't say enough good things about it, honestly. It's done great for my family personally, but becoming your own banker is, I don't even have the words for it, honestly. It has done great things for mine. And, in my opinion, it can do great things for almost anybody's. It's just sticking with it, doing it, and, just seeing the results. Honestly, but for people who want an overnight kind of change, it's probably not for you. But if you're a saver and the money's just sitting in a bank account, I get people all the time, they're like, I've got, $100,000 sitting in a bank account and I'm getting paid 0.03 interest. So it makes sense. And, in the event that, and then people always talk about, well, cash value, death benefit. Understand, it's all death benefit. The cash value, it just happens to be a part of that death benefit. And the beautiful thing about it is the tax advantages, the fact that you're borrowing against the policy and not out of the policy, so it continues to grow uninterrupted compounding interest every single year after year after year. And you never have to worry about a down year because it doesn't happen. And you have contractual guarantees in the policy to an extent that makes it a nice feature. It's safe money. So I always come back to safe money. Insurance products are safe money because they're protected from creditors and garnishments and judgments and all of that stuff. And then they have the tax advantages, and then it's liquid, so you can still access it. And you can access it as a loan, which is not income, and then it's simple interest at that. And then, like I said, depending on the insurance company, those interest rates come down over the years. So, you can't beat it. The wealthy have been doing this for years. Anybody can do it. Just people don't know. And then the flip side of that is that why would you just let your money sit in the bank in a savings account? You can still have an emergency fund, but if you don't need all of it right then, and even then it's still accessible no matter what, usually within a few business days, it's in your bank account. Every now and then it takes longer, but just for the most part, it's still plenty of liquid. There's not that many emergencies that you're really going to have the money right this second. So theoretically, it's an amazing way to get a higher return than just a savings account, one. And two, I have retirement, and I can tell you that with the ups and downs, my insurance policies are going to yield me a higher income. And that's just me. I'm not saying that's everybody's situation. I'm not saying that, and mind you, admittedly, I put a lot more into my life insurance policies as well. But I find that it takes me more in the way that I have to have more growth in my retirement fund. It's a 401k, but I have to have more money in that in order to get equal payout. And then the equal payout, I've still got to worry about paying taxes. So, and as everybody knows, taxes are just going to go up. They've got a bill that's, I don't know. I don't know if it's gone through yet or not. I think it did, but it's raising taxes on everybody. Doesn't matter whether you're middle class, the top, 1%, or, you barely make any money. They're talking about raising taxes. So imagine with all this money that's been spent during the pandemic, even before that, all that has to be paid back at some point. And the only way to do, well, I won't say the only way, but one of the biggest ways that they bring in revenue is the, taxes. And they're hiring like 70 or 80,000 more IRS enforcement officers to collect the money. That just goes to show that it's a money grab at this point, and they're trying to pay that money back at some point. And the problem is they keep spending money, so I don't know that they'll ever pay it back. But things to consider. And down the line, you've got required minimum distributions on, all these retirement accounts. So I don't have to touch my money if I don't want to in my life insurance policies, but I can, and nobody can tax me on it. So anyway, that's a beautiful thing. I'll get off my soapbox, but please like, subscribe, and click the notification bell. Questions, scheduling, it's all down below. Questions in the comments. johnwealthconcepts.com/contact is how you get on my calendar, and we'll catch you on the next one.